Welcome to MFIS Television. Tonight, we want to talk about 401k plans and what to do with your retirement plans once you retire or switch jobs or get laid off. Now, a lot of my clients and my viewers have been asking this over the last few months, so I want to talk to you guys and discuss your options, what you can do with those retirement plans. There's basically 4 options you can do with your retirement plans. With your 401k plan, 457 or 403bs, they all work the same for your 401k plan, 457s, and your 403bs. The first option you can do now is you can keep the money there if the plan administrator allows you to. Now, the thing about that is now you don't have to do, the pro is that there's no paperwork involved in this process. And also, a good thing also is you would keep the investment option that you currently have. But the downfall to keeping your money in your 401k plan or your employer-sponsored retirement plan is there's usually a lot of high fees inside of it that's built in that you don't see. They see the average fee is about 1.5% to 2% inside your 401k plan. So if you have a great year, you get 10% rate of return. After fees, you might be only getting 8% on the great years, and every good year is crucial, especially with this market. And then also another downfall is you're limited on options. So your employer might offer 8, 10, 12, 20 options. It's only limited to that particular administrator, your Fidelity, your Vanguard, and you're not optioned to look at all the thousands of companies out there and the options that are suited for you. Those options are usually suited for the company, but not suiting your best decision and for your best position of where you're trying to accomplish. Now, your second option you can do with this money, which is a common thing, probably the most common, is move this money over to an individual retirement account, or IRA, which we call it. Now, the great thing about rolling this money over is that one thing, usually you have a lot lower fees than your 401k plan, your employer-sponsored plan. Next is you have more options. So you have, with those options, you have more options, more products, and more companies that might fit your philosophy and what you're trying to accomplish. So the plan you might have 20 options but more aggressive, or you might hate the customer service. Well, now you have the option of going to any broker or any company that you like to deal with for those options that might have customer service for you. But here's the drawback to that. Now, when you roll it over, remember, you're not paying any taxes on it, and the growth that you're having is still growing tax deferred. But when you pull out this money, you still have to pay taxes on the money when you pull it out. And that's the same with your 401k plan, your 403b, or any employer-sponsored plan. You're going to have to pay taxes when you pull out this money. Now, another option that's really getting popular now, which is a spin-off of the IRA, is the Roth individual retirement account, or the Roth IRA. Now, just like the IRA, it has lower fees than your 401k, your 457, or anything with low fees. Okay? And you have tons of options, just like an IRA. And the problem why everybody's getting love because you get the income when you pull out the money for retirement is all coming out tax-free, which is a huge thing, especially if you feel like taxes are going to go up in the future. This Roth IRA is going to be tax-free. But the drawback of it is you're going to have to pay taxes now on your money. And it cannot come out of your savings account. So let's give you an example. You had $100,000, you just rolled over to a Roth IRA. Now, this $100,000 will have to pay federal income taxes. So if you're in a 25% tax bracket, you're going to have to pay $25,000 in taxes. And if you're in a state with a high state taxes, you have to pay 9%. So you're going to have to pay $34,000 in taxes on this money. Now, this $34,000 in taxes is not coming out of the retirement account. It has to come out of your own personal savings account. So you have to be smart when you do these things to make sure you have the liquidity in your savings account to endure this big tax hit when you do roll over that money. The only way you can roll it over with to a Roth without worrying about this $34,000 tax hit is if you are older than 59 and a half, where you have time to pull out the money without any penalties. Now, a strategy a lot of people might be doing is this. You might pull out the $100,000 and put $50,000 in an IRA. So now they're not paying any tax on that IRA. But with this $100,000 you have, you might put the other $50,000 in a Roth IRA, because now you can afford to pay the taxes on the Roth IRA, because you want this money to grow tax-free. Now the great thing about this $50,000 now is if you have the liquidity, instead of paying $34,000 in taxes, now you can only be paying $16,500 in taxes. And whenever your IRA grows, you can continue to put money annually into the Roth IRA or your good years into your individual retirement account. Now the last one I don't recommend unless it's emergency for a retirement account, and that's just strictly cashing it out. Taking the cash and run. The reason I don't recommend this is because you have to pay a huge amount of taxes and penalties. Let's give you an example. You have $100,000. You take out because it's an emergency, you've been laid off for a while, and hey, I got this money on my retirement. Well, this $100,000 now has to pay state, federal taxes at 25%. You have to pay federal penalty, which is 10%, so another 10 grand. And then you have to pay state income taxes, which is 9.5%. And then you have to pay the state penalty tax, which is 2.5%. So with all this, you should add up these numbers, 25, 10, another 9.5, 2.5, you're at almost 50%. You're getting about you owe $45,000 in taxes, which means you only get $55,000 in your pocket. So the only time I recommend this if it's the last case emergency. When it's a rainy day and you've been laid off and you're just in a survival stage where retirement planning is out the door, where it's out the bag, where you can't just retire. You're now trying to survive and just trying to eat. Now with these simple tips now, you're a lot more educated on what to do with your 401k plan and other employer-sponsored accounts. Now if you have any other questions about what we discussed, please email me at matthewsfinancial@gmail.com. Go to our website, matthewsfinancialinsuranceSolutions.com. Find us on Twitter, Facebook, LinkedIn, and have a good evening. Or, last but not least, give us a call at 510-229-7608. And once again, my name is Jason Matthews with MFIS Television. Good night.